Hello, my name is Ed Durbin, and this is a short kind of presentation on the yield curve and the term structure of interest rates. And the objective, of course, is understanding some of the theories and the background regarding those the yield curve and again the term structure of interest rates, market behavior, etc. So it's pretty straightforward, but the idea is, again, that the term structure of interest rates, it shows a relationship between the long-term interest rates and the short-term interest rates. And that's depicted, illustrated, if you will, with the yield curve. And there are a variety of yield curves, but the one that I'm going to be focusing on is the kind of the standard one that we tend to look at, and that would be the U.S. Treasury yield curve, going out from about a month to the 30-year long bond. And again, this is what it's depicted. And so the dominant theory that we currently see is the expectations theory, the expectations of what interest rates are, the market, writ large, if you will, the market anticipating what those rates would be going forward in the future. Anyhow, embedded in that would be a lot of different things, including inflation, of course, and that's kind of the primary one that most people focus on. But there are other considerations as well, including, of course, the Federal Reserve through the FOMC, their actions with the federal funds rate. And at any rate, other theories would be such things as the preferred habitat and segmented market theories that were more relevant, if you will, in the past. We won't go any further than that, just to a quick description on that. So in reference to the preferred habitat and also the segmented market theories and long-term, in the term structure of interest rates. So just after, but especially prior to the Second World War, so we're going back 80 years now at this point, the dominant management philosophy of commercial banking was the commercial loan doctrine. Banks have low capital ratios and have very liquid liabilities. This was kind of the rule, if you will. The commercial loan doctrine argued that due to these vulnerable relationships, banks should make only short-term and self-liquidating loans to business. For the most part, that meant loans to businesses to finance their working capital needs. Again, we're talking about short-term, just a year or two out, perhaps. Business was supposed to finance long-term capital needs with long-term financing, such as bonds and stocks. Similarly, insurance companies were the long-term suppliers of capital for plant and equipment needs. There would be other entities as well, but that's kind of the general idea, pension funds and the like. Investment bankers would aid in raising that long-term capital by acting as brokers and dealers in the bonds and stock markets. This all changed, however, gradually after the Second World War as the financial markets in the U.S. matured and developed. Accessibility to short-term funds led to the shiftability doctrine that in turn was used as an argument for banks to extend maturities of their loans. The ability to issue other liabilities, now term borrowed, or purchase funds, led to more current management philosophy of the ALMS, asset liability management, or asset liability management. The commercial loan doctrine faded away as a result. Long-term lenders, like insurance companies facing a flat and downward sloping yield curve, began to invest kind of heavily in the short end of the financial markets. The segmented markets, or preferred habitat theory of the term structure, also faded away. Relative scarcity in the short term of markets relative to the long-term end of the markets was no longer the reason for a downward or inverted yield curve. Relative scarcity of long-term credit relative to short-term credit was no longer the reason for an upward sloping yield curve. I'm mixing my metaphors here, right? Again, we're speaking about yield curves. Going forward, it was the market expectations of the participants as the pattern of expected future short-term interest rates. Again, think such things as inflation, etc. that would determine the shape of the term structure of interest and the yield curve itself. So in this graphic, I just wanted to represent, it's kind of busy, but it's pretty straightforward actually. We're looking at four different yield curves, if you will, over a period of time, going back to 2020, end of 2020, and end of 2022, and end of 2023, and end of 2025. So in 2020, we had extremely low interest rates across the board pretty much. And a lot of that was fed by Fed policy, federal FOMC policy in terms of driving down the Fed funds rate to spur on growth as a result of COVID, et cetera. And I actually was kind of a leftover from going back many, many years, of course, to the collapse in 2008. Interest rates had stayed pretty low. There was some upward movement, but the Fed funds rate was quite low up through COVID again to kind of support the markets, if you will. Anyway, so 2022, end of 2022, we started to see some movement, and it kind of, when I say movement, the interest rates were rising in the near term, and that was reflected as a reflection of the higher inflation that we were seeing. And again, we're talking about the markets. It's reflected in the markets in terms of those higher rates. And again, along with the FOMC, the Federal Open Market Committee's policy in terms of driving rates up too in the short run, but that didn't come until quite late, until quite recent actually. And that is reflected in the year 2023 toward the end, where we definitely had what you could picture an inverted yield curve, meaning that the near-term rates were quite high, and the longer-term rates were lower. So it's again tilting downward to the right. So in the second graph, we took out the 2020 numbers, and so this is probably a better reflection of easier to see illustrate what was going on with the yield curve itself. Now again, the yield curve is it's the yield curve of the U.S. Treasury securities, so the entire portfolio of our $36 trillion that we currently have in our debt. These are the securities that have been issued 1 month out to the 30-year long bond. At any rate, so what we're seeing is that, again, we're seeing that inflation, the result of inflation being tamped down, and also the Fed funds, the FOMC's policy in terms of driving the rates back up from the zero rate, if you will. And I won't go into that much further, but again, this is an illustration of what was going on. The change, if you will, from the end of 2023, so 1 year ago, we saw the near term or the short term rates dropping from 5.6% down to 4.4%, and they will continue to come down, assuming that we have continued policies and continued reduction in inflation and other factors that we'll kind of touch upon a little bit. And the longer term rate in this year, we're just looking at the 10-year, or in this case, we're just looking at the 10-year moving up, so tilting back upward to the right into a more normal shaped yield curve, sloping upward to the right. So back to this upward or downward sloping yield curve. So the short-term lenders, in this case, we're talking about commercial banks, were loaned up. This is, kind of the standard operating procedure. We're loaned up while long-term lenders, insurance companies, and investors in the bond market had an abundance of funds, if you will. They were overflowing, looking for places to lend, looking for creditors out there, borrowers rather. At any rate, funds for long-term lending. Hence, there was a flat or downward sloping yield curve. When this picture was reversed, the yield curve would, of course, slope upward to the right when things were kind of balanced out more, if you will. So onward we go. So the liquidity bias and expectation hypothesis theories of the yield curve. So the liquidity bias theory of the yield curve, or term structure of interest rates, argued that the yield should always slope upward to the right. Again, think of it in terms of liquidity is good and illiquidity is bad, right? You want to be able to pay your bills. You want to be able to pay the interest for your, to your borrowers, or to your et cetera. You want to make sure that you are liquid. To be liquid, then borrowers would have to borrow long term, and lenders would have to lend short term. This would lead to a dichotomy in the market. So there's a mismatch, if you will. To resolve the problem, borrowers would be given a lower short-term interest rate to become less liquid, to attract them, if you will. So lenders would then be rewarded for becoming less liquid and lending long-term with higher interest rates, time value of money, et cetera, right? Pretty basic stuff. So to resolve the dichotomy, the yield curve must slope upward to the right, again reflecting that time value of money. Unfortunately, it does not always behave in this manner, as we've witnessed over the course of the last few years. So toward the peak of the credit cycle, or the peak of inflationary episode, the yield curve typically again slopes downward to the right. For example, what was going on in 2021 through early 2024. There is no doubt that there is a liquidity bias. There's a bias toward liquidity. People want to be liquid. But it is just one of several factors that influence the term structure, its graph, which is represented as the yield curve. So bear in mind that while the FOMC, the Federal Open Market Committee, might be lowering federal funds target rate, for example, and effective Fed funds rate, it doesn't necessarily that it will be immediately reflected in the yield curve, or vice versa. The market writ large will sort this out, and if the inflation is tamped down, think in terms of controlling fiscal spending and reduced pressures on energy costs, for example, then it will increasingly be reflected in a more normalizing yield curve. Again, a lot of factors being thrown in where the yield curve is sloping upward and to the right. So again, to kind of reiterate what we just went through, so this liquidity bias and expectation hypothesis. So liquidity bias basically means that there's a bias toward having your money in your possession, right? To have your funds available for spending and for use in the near term to cover your bills, et cetera. So the yield curve should again slope upward as lenders demand higher rates for longer term loans, again reflected in time value of money, you being separated from your funds, et cetera. Expectations hypothesis, the curve reflects the anticipated short-term rates. Again, focusing on the short-term rates. So the changes again are dependent upon what? On the market. The market kind of writ large, using that expression again. The market, the overall, what the market sees looking forward, going into the future. That crystal ball that forms those market expectations. So influences include market cycles themselves, inflationary pressures, of course, Federal Reserve policies. The list goes on and on and on when we start talking about embedded risks and so on and so forth. But that's generally the idea. This is the market that is determining, that influences these interest rates, if you will. So to kind of put a bow around this is again very very short presentation, but hopefully it kind of gives you some ideas of what is happening out there, at least from an economic standpoint. So peaks of credit cycles or inflation often produces downward sloping demand curves. Excuse me, demand curves. Listen to me. Downward sloping yield curves, and so this is in this people oftentimes read this as pointing toward recession, et cetera. Perhaps not. At any rate, FOMC actions on interest rates don't always immediately affect that curve, the yield curve. And we witness that now, where we see interest rates, quote unquote, coming, going up, and like a more of a normalizing yield curve, and yet we don't see the interest rates that we might expect to be, coming down a bit, like in the longer term, such as like mortgage rates, et cetera, which are pretty much based on the 10-year. But anyhow, you get the idea. There's not an immediate impact. There's a bit of a lag, and that'll be another discussion when we start talking about rational expectations and adaptive lag and lots of other things that are kind of can be considered. So again, normalized yield curve again depends on a good deal on taming inflation, such things as that, stabilizing fiscal pressures, and we could throw the monetary policies in there as well, coming from the Fed. So anyhow, hopefully this will give you a quick overview of the yield curve, if you will, term structure.